Go live with me drinking. Very first thing, we drinking coffee. Hey, everybody. Good to see you. Good morning. Glad here. Yes, I still have a great haircut. This lasted a whole day. I'm proud of myself. Glad everyone could be here. Grab yourself a cup of coffee. We're going to get started here in just a second. Make sure you smack those emojis. Pick your favorite. I kind of like that one that looks curious in purple. I don't know why they picked purple for the face doing this. That looks like a bad glamour shot too, by the way. And for those of you that understand that reference, thank you, my 80s and 90s people. Everyone born after the 80s and 90s, like my producer Tobias, has no clue what I'm talking about. Bless his heart. All right, with that, let's get started. Welcome, everybody. 60th episode. 60th. Wow. Lowell is our 60th guest. 60th episode of FinTech Insider, the Breakfast Show US. I'm Sam All, 11 of us Managing Director of North America. I'll be your host for this show. Please let us know where you're watching from around the globe. Love seeing folks in from Manila, from Spain, from South Africa, Nigeria, Saudi Arabia, with Dr. Abdullah. Great to have you all on. Let us know where you're at in the comment section, and please share this stream. So you see that little share link down at the bottom in the bold white Goldman Sachs font. Please click on that and let your network know that we are live, and smack those like buttons. And most importantly, subscribe. Subscribe to 11FS here on LinkedIn and to our podcast, FinTech Insider. If you haven't read our latest research report that we did together with Plaid, how's that for a placement shout out, about open finance and how it's going to shape this industry, then go find it on the link that lovely Bianca will put in the comment section, or just go out to bit.ly/open finance 2020. Okay, 3 news stories that caught my attention over the past 24 hours and should have yours. The first one is from MSNBC. U.S. banking regulators are about to ease restrictions created in the aftermath of the Great Recession, a development that sent bank stocks surging Thursday. The FDIC officials said on a call that they are loosening the restrictions from the Volcker rule, allowing banks to more easily make large investments in venture capital and similar funds. The banks will also be able to avoid setting aside cash for derivative trades between different units of the same firm, potentially freeing up billions of dollars in capital for the industry. Shares of big banks, including Chase, Goldman Sachs, Wells Fargo, and Morgan Stanley, were all trading more than 2% higher following the announcement, reversing declines in the pre-market. In line with the broad push by the White House to roll back regulations put in place by previous administrations, Obama, while the banking industry has acknowledged the benefits of While the banking industry has acknowledged, I cracked myself up with that one, folks. While the banking industry has acknowledged the benefits of being required to hold more capital to cushion losses, lobbying groups and individuals, including Jamie Dimon at Chase, have criticized part of the post-financial crisis regulatory regime as being overly restrictive or redundant. The Volcker rule is part of the 2010 Dodd-Frank Act, which was passed in an attempt to prevent another financial crisis caused in part by irresponsible risk-taking at banks. My 2 cents on this, yeah, in some ways we definitely did go overboard. And what I would say to the banks right now, please do not screw this up. Second story from CFO Magazine. They report the U.S. mortgage delinquency rate rose in May to its highest level in more than 8 years, though homeowners have been making a higher share of payments this month as Americans continue to struggle to pay bills amid the COVID-19 pandemic. Another 723,000 homeowners became past due on their mortgages in May, pushing the delinquency rate to 7.76%, according to property research firm Black Knight. The delinquency rate was 6.45% in April and 3.39% in March, when states began issuing stay-at-home orders to try to stem the spread of COVID-19. Serious delinquencies, which means mortgages that are 90 days past due but not yet in foreclosure, increased 36.5% to 631,000 in May over the previous month. While the May additions, and with the May additions, there are now 4.3 million homeowners past due on their mortgages or in active foreclosure, up from 2 million at the end of March. If you can't do math, that's 2.3 million increase. However, Black Knight also noted the higher share of payments that have been made thus far in June than at the same time in May, suggesting the rise in delinquencies may be leveling off. And finally, from TechCrunch, Carrot, that is K-A-R-A-T, like the diamond, is a new startup promising to build better banking products for the creators who are making a living on YouTube, Instagram, Twitch, and other online platforms. Today, it's unveiling its first product, the Carrot Black Card. The startup, which is part of the Accelerator Y Combinator's Winter 2020 batch, is also announcing it has raised $4.6 million in seed funding from Twitch co-founder Kevin Lin, Signalfire, YC, CRV, and Koto. Co-founder and CEO Eric Y knows the creator world well, thanks to his time as a product manager for Instagram Live. With the Carrot Black Card, the startup is giving creators a credit card that can be used for their business-related expenses. When creators are approved, they receive a $250 signing bonus that can be applied to any future purchases of electronics or equipment. The card also comes with custom designs, 2% to 5% cash back on purchases, and even offers advances on sponsorship payments. Underlying it, we said Carrot has developed an underwriting model that works for creators. Instead of looking at credit scores, Carrot focuses on the size of a creator's following, their current revenue, and whether or not they're business savvy. My response to this? All right, let's introduce our guest, Lowell Putnam. Lowell is the head of partnerships at Plaid. On today's show, we're going to talk about partnerships at Plaid, how open finance will shape the industry. Lowell, how are you?
Doing well. Nice to see you, Sam.
Did you get the Carrot Black Card? Because you are a massive social influencer.
I have not. Although, are you going to put my TikTok handle up at the end of the show? That's part of my rider is my TikTok handle has to be displayed at all times.
Yeah, I tried that. All TikTok videos look like this. So moving on, let's really dive in and let's talk about your wife. So Bryn, Bryn Putnam is the founder and CEO of Mirror. Let's talk about Mirror. That's that fitness app that, man, you see everywhere. She gets the first shout out. Come on, dude. How's that been going throughout the COVID shutdown?
No, it is very exciting that like 5 years ago, I got introduced as aggregation CEO, open finance person. And for the past 3 years, I've been introduced exclusively as Bryn's husband. And I can't blame anyone for doing that. Account aggregation just really isn't as interesting as Mirror, which is pretty incredible product. So my wife ran a gym, a boutique studio in New York for about 10 years. And then decided, okay, am I going to expand to Westchester, New Jersey, or am I going to go in home? If I want to touch millions of people, I have to go in home. Peloton was already taking off, but there wasn't that much happening because to do hardware and software and content are three different businesses rolled together. Yeah. So she made the Mirror. No one wanted to give her money at first because they say, well, why don't you just take your TV? Why isn't this just YouTube, right?
Right.
I already have a phone, I've got a computer. But it is different. Fitness is an experience, and this is an experiential product. And so it hit, and then anyone who tried it immediately tried to invest in it because it is totally different. It's really immersive. It's an awesome product. It's also reasonably affordable. It's pretty affordable to make because it's controlled by your phone. There's not 500 things that can break in it. It's a really awesome product. And COVID's been, obviously, it's horrible that people can't go to the gym or work out as easily, but it's creating this huge behavior shift, which is maybe my home can be my gym. And that once you actually flip that switch and say, I don't need an Equinox, I actually can get everything that I need for really, really good content at home, that changes everything. And so every day has literally been like Christmas. Like the holiday season of last year is basically every day of 2024.
Man, I can only imagine. And they also do have a physical store right down in Flatiron, on one of my favorite streets, by the way, down there. So I remember walking by there that was close to the 11FS office down in New York, and I saw that. It just made me smile. I told Lowell I wanted to stick my head in and go, Lowell Putnam rules, but I didn't do that because I thought it just wouldn't go over well. But
we need to keep the share price up.
Yes. That said, Lowell, you are pretty cool. So you had a company called Quovo that you went through an acquisition with Plaid. The last time that we met I think it was in New York, was actually the day after the contract and everything was finalized, which was fantastic. So that was a couple of years ago now. And now, can you talk about your role at Plaid and what you do there?
Yes, that was 18 months ago. And my role is I had partnerships for Plaid. Historically, Plaid was really a developer-focused brand, right? If you wanted to build something in fintech, Plaid was the natural place you went. You got Nate Yike, you built something amazing, and a lot of the biggest apps today in the fintech space use Plaid as really a core piece of their infrastructure, right? It's a piece of your onboarding for an Acorns or a Betterment account. You link an outside account, or Venmo, you link an account and you transfer money in and out. And Plaid is the infrastructure for that. It's really the closest thing to open banking that exists in America is Plaid. But with the acquisition of Quovo, which focused more in enterprise, wealth management, non-bank data, I think Plaid's really moving on to the next step of its company's evolution, which is up markets, more complicated customers, probably less tech-savvy customers. We're selling to fewer developers and more product owners, business stakeholders, CFOs, CEOs, which are really different. They can't just grab an API key and get to work hacking away. So the partnership program that I run allows us to penetrate places like lending or payments or banking, where a regional or community bank just doesn't have the bandwidth to get an API key and build something amazing, right? So what we do is we partner with their core banking system, we partner with their account opening platform, with their PFM platform, and then it allows banks, lenders, and other people to access our services without having to build from scratch. So we're never going to give up on the developer first brand that Plaid really made its market. But as we look at 8 verticals, 10 verticals, really becoming a horizontal SaaS company, we just can't touch all of those through direct sales. And so that's what I run. It's really interesting also because these are the most difficult for anyone who's tried to work in B2B SaaS. The most difficult deals to get across aren't the ones where you have to prove the value of the product. That's usually pretty easy. It's actually navigating the infrastructure of your customer to get them to actually take your product and put it into production. And so that's why partnerships really help reach those industries where you can't just sell to a person and that one person makes it happen.
Well, I'm curious from your perspective. I'm going to sound like it's The Bachelor and your own personal journey, Lowell. But you've gone from founding and launching and running a successful company in Quovo to going through an acquisition with Plaid and Zach and that team, great team by the way, to now going through an acquisition with Visa, right? And you're doing all this in a period of around 18 months, 2 years. How has that journey been? What's it been like?
I didn't see the second acquisition coming.
Neither did I, Lowell. Hey, didn't see that coming whatsoever.
So I guess the first piece of the double acquisition is it made me really excited for my team at Quovo, right? I hired 100 people, and we were always underfunded. We were always on our heels in the market, which is so difficult with the kind of aggregation things that we did. And the best I could do was say, bear with me, this will work out for us. So being acquired by Plaid, where sometimes we were competitors, sometimes we were partners, that was a big step to take, not just for me, but for 100 other people, to say, we're now trading in a lottery ticket for a new lottery ticket in a lot of ways. And it's a really, really big step for folks who are on their first job or who left traditional finance or other places and now are jumping into startups and now actually bouncing from startup to startup or getting absorbed by another one. The big valuation is scary. So by far the best part of the past year is being able to tell people that put their trust in me and my co-founders that we made the right choice. We found the right partners. Plaid is going to be the winner in this space with our help, and there's going to be an outcome. And that outcome with Visa happened much sooner than we expected. Also, I think it means we've got this sort of like this SWAT team, this Green Beret team of people who've just been through it before. And so people are really ready to go through another integration and they're not freaked out. Because change is very scary for anybody, especially early in their career. And so it's very cool that people on my team have seen it before, and Visa is just the next chapter of this.
Yeah, I think every single one of us that looked at this when it happened went, oh, that was good. Good move. Good move by Visa. Obviously, we've seen what MasterCard has done through their acquisition, waiting for Amex now to go out and do something. We'll see. But it just proves in the U.S. when it comes to open finance, which we just so happen to have written a paper with Plaid on about. You can actually see the link over here in the comments. But that open finance in the U.S. is taking off. That the concept of this is definitely is one worth paying attention to, folks.
Yeah, I tend to, when I think about the commercial side of our business, I break our sales into two pieces, which is education and then actual business development. And so you can't sell into a company or into a category if that category is not educated as the general value of the product. And over the past 5 or 6 years, I've seen that education process go from very difficult to non-existent because it's being done for us. Like you take the wealth management space. 5, 6 years ago, do we need to see everyone else's assets? Yeah, I think so. Pretty useful. Today, no brainer. There is zero education Plaid has to do about why we want to service the wealth management space, the account opening space for banking, the need for linked accounts for neobanking. It's very, very cool that industry by industry, vertical by vertical, we don't need to educate. They're drinking the Kool-Aid. They understand why our products have value. And so now it's just a question of the how. It's not a question of if. And that's why we say open finance. It's sort of a tautology, right? It's not something we have to prove. It's describing a state of the world that is already coming to be.
So Dan is with the London FinTech Frictionless Seamless Association. Oh my God, that's the best name ever, Dan. I love that. He asked, this is a very open question. How did Plaid catch up to and surpass Yodely? That's a good question, Dan, actually, because Yodely did have a good 10-year head start on Plaid.
It's a really good question. So we'll set aside like the core infrastructure, which is build an API that's easier for developers to use and stays up all the time. And in that case, Plaid and Quovo both had huge advantages because they weren't building legacy platforms. So other legacy aggregators had built the first version of their system in 2000, and then had to keep upgrading. Upgrading is always more complicated than building that new. And so in terms of building the data distribution network, I think we had a big advantage over that with zero tech debt, right? We just got to step right into a RESTful API world and build to a standard that the entire world had agreed was the right way to do things going forward. So that was only easy. It was easy to have advantage. The really hard part that question I think touches on is coverage, because we do build connections to institutions one at a time, or if we're lucky, 100 at a time if we get a core banking system or a platform that services a lot of banks. And in our space, unlike most businesses, the MVP isn't 3 connections, because that just doesn't service enough of your customers. If you don't service 98% of a PFM customer's banks, we're a useless vendor to you. And so there's that necessary but not sufficient ticker that keeps going up over time, and that magic number is in the hundreds. So basically, until you have hundreds of bank connections, you are not a viable aggregation provider. You just can't connect enough accounts. And so that's really the difficult piece, is that both Plaid and Quovo, and then easier together, had to put in the time with their early customers, and they had to have friendly customers to actually say, hey, just so you know, the first bank account you give us at Bank of Danvers, Massachusetts, will fail until we build it out. Are you comfortable with the first customer on every institution having a horrible experience, and the second one having a moderately horrible experience, and then the third one having an okay experience? And a bunch of customers weren't okay with that, and they went to the incumbents that already had Bank of Danvers. So that was really the difficult part, was getting through that valley in the middle of, I don't know what the magic number was, called 500 institutions that had to get built one by one and then maintained. And that was it. And that was just finding customers that could deal with the pain with us.
So Dan, I'd add to Lowell's answer with this, and 11FS has tried to embrace this and how we grow. Hire really good people, man. Be picky. Man, be picky about who you hire and bring on. If you look at what Quovo has done, and then what Plaid has done, and Zach and his team and the leadership team, and Lowell on his side, be very picky who you bring in and make sure they're incredibly good. And if you look at a lot of these companies that are succeeding, where everyone said there's no way it was going to happen. So I'm looking at Stripe, I'm looking at Square, I'm looking at Plaid, and a few others. The teams are just loaded. Man, they're loaded. And not with people from the industry that you look at and go, oh, wow, they signed another Kobe Bryant. People you've never heard of that are just rock stars that in a couple of years you'll hear of.
I'm a big fan of functional hiring, usually because you need to be. That any good startup is cash strapped, and so anyone that you hire, I think, should come in and be able to provide value a little bit early on in one area is really, really key. And then hopefully they have a really high ceiling. So the way that I think of hiring is immediate value for the function you're hiring for and a super high ceiling for whatever comes next. And no offense, that almost definitely does not mean someone out of HBS.
Yeah.
Because their ceiling is probably high. I don't know. It's very hard to tell until you spend a lot of time with them. And their ability to add functional value on day one is almost always zero. Oh, and then the last piece of advice I give for everyone is like, when you're in college, if you get 90% of things right, you get an A. That in the real world, you need to get 100% of things right. Is that attention to detail on tiny, boring tasks is what makes a good employee, because no matter how amazing your business is, 75% of it is pretty boring shit. So, sorry, completely out in post.
No. Here, I'll make you feel better, Lowell. Yesterday in a call, I used the MFer word.
Okay.
So you're fine, Lowell, and we still have that client. So we'll just move on.
Good. So so much of your stuff is boring and routine that finding people who are able to get everything right, no matter how boring it is such a key attribute for those early hires.
Man, I love that answer. I agree with you because, again, I grew up in banks, right? I grew up in service companies like TSYS and others. And as a manager, as a director, as a program manager, you take your pick. The one thing you want to do is not have to hyper manage. You want to be able to trust the people that you have in your teams to do the boring shit, to get it done and not have me sitting all on top of them, right? I mean, that's the teams you want. And I agree with you. A lot of this is incredibly boring. It's monotonous. And that's usually where mistakes happen, by the way, just flat out. That's where.
That's exactly right. No matter how smart you are, you will make a mistake on something boring.
Yes.
So hiring people that don't mind spending the 5 minutes going back and rechecking their work, even though it is definitively, quote, beneath them based on how great their resumes are, that lack of ego is so important, especially in a business like account aggregation and authentication like ours, where, I don't know, a third of our time is spent maintaining the connections that we built 3 years ago. It's pretty unglamorous work. When Huntington Bank breaks, we got to figure out how to fix it and call them up and deal with it. And it's not pretty, and no one says thank you. And so I think that having sort of picks and shovels or working in a plumbing business is really helpful. And so I get excited to see what the engineers are going to go do next from Plaid, because they've learned some really, really good, I think, old school work ethic tools from this type of business. And then maybe they'll go work on something that doesn't require as much maintenance, but it means that they'll be bringing that sort of slavish and insane attention to detail to probably a simpler product, and they're going to crush it. It's going to go so much faster.
How do you? This is a question from me. How do you maintain that level of output with your teams when it is this? Because I mean, you told me this the very first time I talked with you, Lowell, is that you can't afford mistakes, and what you do, right? The ability for folks to get to that data. This is financial data, right? Mm-hmm. And so obviously it has the eye of every little hack shop in the Ukraine and Kansas City, for that point, across the globe, wanting to do these attacks. How do you maintain that level as a management team? That level of motivation, that attention to detail. How do you do it?
I think I'll tell you, there's sort of a danger in the best tool that we have, which is that dedicating time to monitoring yourself is a big piece of it. A huge chunk of our code monitors the stuff that we do every night and allows us to see what's actually happening inside of our own systems. And the really, really hard part about that is spending time and dedicating cycles to something that doesn't generate revenue. Yeah. It just allows the next thing to go a little bit faster. Is a balance that we are always working on, and at least from our COVID days, we were always getting it wrong. We were always over-invested in admin tools that nobody used, and we'd have to throw them out, and it felt like wasted time. Or we under-invested and then had to scramble to build new ones. But the idea of getting just that balance right of self-monitoring and self-management is something that, at least in an infrastructure business, is worth doing. And I think that that's an investment that goes up and down over time. But it really pays off because I think, to your point, the worst thing that can possibly happen is there's a problem, because there will be a problem. Technology breaks, it's just what it does. and how quickly you can triage it really defines what kind of organization you are. And so it's how much preparation you put in for that kind of thing. I think that's really the key for us. And I know that it sounds like a line and it sounds stupid, but being customer centric, being support centric is something that we put into our DNA early, which is, it's not sexy at all to say that our customer support team should be able to outvote our engineering team.
Yeah.
No one wants to hear that, right? No CTO in the world wants their genius to be tempered by probably the most junior person at the entire company. But if someone's representing the voice of a customer, you need to build a culture where that voice of the customer is brought back in, and that's how we prioritize our time.
All right, so we got time for one more question.
Yes.
I'm going to let Siddharth get this one in. So Siddharth is basically talking about, I'm going to summarize your question, Siddharth, about kind of the blowback from consumers around, the idea of ad tracking via cookies and being suspicious of big tech and their data. By the way, Siddharth, if you didn't see the news today, Google's going to see their advertising revenue is predicted to drop for the first time ever, to talk about some of the impacts of COVID. Story worth taking a look at, by the way. But what he asked is, what lessons can we learn from the ads blowback to make this experience of data aggregation across accounts to be more privacy sensitive, so we don't have the same blowback as, say, the marketing ties has?
It's consent based, right? I think there's an advantage that we have in account aggregation, where every time you link your account, you are putting in your credentials, and it's not ideal that you have to go through that friction and do MFA, but we are lucky. As a category of a company goes, nobody accidentally sets up a Venmo account and links their account to it. So
thank you, by the way. Yes.
So there's this moment of affirmative consent when the linkage happens, and it has to happen. So that gives us an opportunity to put whatever it is around there. So what I use the term, and I wish, and I don't know if it makes sense, but I use the term conspicuous consent. It's not about having the right things in your terms of use. It's just about the text being red and the background being green or whatever it is that makes it really, really clear that you are consenting to a thing at that moment. And then I think the second piece of your question is, how long does the data persist and what data elements are being shared and for what purpose? And so that data permissioning layer is basically a product in and of itself. And it's something that Plaid and Quovo both put effort into, and I think we'll admit not enough effort into. It's something that we're going to be working on over the next couple of years to make the consent process that a little bit more granular and a little bit more transparent, and having more of an eye towards informing the consumer without becoming a direct-to-consumer company is a brand new type of infrastructure, right? It's a very different type of infrastructure company. You think about what utilities have had to do in the last 15 years to actually tell customers what they're actually using, and the ability to see inside their own utility utilization in a way that certainly didn't happen 20 or 30 years ago. It's the exact same thing that's happening in the new utility, which is data. And so hopefully we can move a lot faster than Con Ed did, but that's the idea, is to give you that same meter reading ability inside our dashboards and our tools.
Yeah, it makes all the sense in the world. It's been, I tell you, I've said a couple times on this show, and confess that, way back in the day when I met Zach, in a dive bar in San Francisco, and he told me the idea of what he wanted to do with Plaid, and I said, "Good luck, buddy," and pat him on the back and thought, "Dude, you're dreaming." How stupid I am, and good for him for proving me wrong. Good for you for proving me wrong. And it's encouraging to see where the U.S. market is moving to. Right, I'm thrilled about that. So, Lowell, probably the most important question: where can people find more out about the mirror and what Bryn is doing? No. She got enough shout outs, guys. Go Google the mirror. It's an awesome workout. What about Plaid and the partnership side? Where's the best place for them to learn more about that?
Just go to plaid.com. We've got a page on the website for partnerships. And I think I'd say the same thing that Zach says is think creatively. Think about what you can do. You knew more about your customers, and your customers were excited to share information with you, and you will come up with the next use case. The coolest thing consistently over the past almost decade of working in this space is when a customer shows up and I'd never even thought of that work stream before or that use case before. So please bring us the next thing that we haven't even thought about before. It happens like times a year, and it's always the best moment for leadership.
Love that. All right, folks, that's it for this week, believe it or not. On Monday, this is cool. I didn't even know this. On Monday, I'm going to be joined by Tom Bianco from Fifth Third. Great bank. Love Fifth Third just got their national banking license, and Tom heads up digital on the commercial side of the house for them. And Tom is a trip. I really like. I like Tom a lot, so that should be fun. As for me, you can ping me on Twitter. That's @SamMall. You can find me on LinkedIn or just email me at sam@11fs.com. Look for me on TikTok doing my mirror exercises. I have a whole workout regime that you can follow, and you'll look just like this. Or you can ping us at breakfastshow@11fs.com and talk directly to the producers. Tell us who you think would be great on the show. Thanks for everybody for watching. Have a great weekend, and we'll see you on Monday.